From housing crash to global clash, the question is, what are you going to do with your cash? On today's episode, we're going to cover the most current real estate headlines.
And we're going to take a look at all of the provincial housing data and the economic data, as well as talk about the Toronto and Vancouver condo meltdown. It's getting worse, JG.
Now listen, debt to GDP is at record highs. Is something going to break? Yeah, probably. And CMHC just figured out that they would go broke if they achieve their objective. We're going to dig into that and much more. Ladies and gentlemen, welcome to episode number 67.
And don't forget, like, subscribe, comment, get those algorithms kicked up. Listen in, enjoy.
All right, Patrick, one of the first headlines here I want to cover and talk about is this one that talks about more than half of Canadian renters plan to buy. That's what they say. Question is, what is holding them back? Now, I actually have some pretty strong feelings about this one, but let's talk about this article because I've seen this firsthand. You and I talk about this on many episodes. Like, we've seen some phenomenal renters that should not be renting right now. Like, they should be buying. It's a great time for them to buy. The question is they're hesitant. It's also very difficult for them. But man, these people should be buying homes in order to fire up this real estate business.
Well, something I got to say is that, being in this industry as many years as I have, this is not a new headline. It says, it's like revealing that 54% of Canadian renters. Okay, well, let's face it. Most renters or many renters ultimately want to buy a home. Now, I think that's changing, by the way, because I think there's a number of a certain, cohort that's saying, no, I don't want to own, I'm going to rent forever. They also don't want to own a car, et cetera. But that's part of it. The next part of it is, to your point, is that when you look at affordability, it's still an issue. As much as housing prices have come down off of all-time highs, they are far from being at all-time lows, and they got a long way to go, and they're probably never going to get there. So the point is that renters ultimately they do want to buy, and so it's kind of a what do you say about this headline? It's not much of a headline, other than it is very difficult for people, first-time home buyers, particularly, to get in the game because of affordability. And to your point earlier, JG, we were talking off camera, and just how much heavy lifting it is to get a mortgage these days.
Well, that's actually where I wanted to go with this conversation is just that I've renewed, I don't know how many, Patrick, like I don't know, a dozen or two mortgages in the last couple of weeks, and it is so heavy lifting. I mean, in some properties, I've resorted to just buying out the mortgage and holding them in cash. Like, I'm not kidding. That's how difficult they're making it. And it's crazy. It really is crazy. And I'm actually seeing them, as in the lenders, as a huge reason why this market isn't spinning up the way it should be spinning up. I mean, listen, the pricing is good. Mortgage rates have come down. I was talking to a couple like just regular Joe buyers, and they were getting mortgages for 3.7, 3.6, 3.8. Like, yeah, like that's not a bad mortgage rate. There's nothing wrong with that. I've got a mortgage. I got some mortgages on my rentals. I got some in the fours. I got some in the fives, but I got some in the fours. And like I always say, as a real estate investor, if you can get a mortgage for 4.5, 4.3, 4.2 as a real estate investor, you can make money in this business. Now at 6 and 7%, very difficult, but 4.5, low fives, you can make it work, especially if there's a path to getting into the fours. But my gosh, the financing companies are making it so difficult right now. I mean, I'm not kidding you. I thought they were going to ask me for a blood sample last week. Like, they asked me for every document, every hair follicle. And, like, it's crazy the stuff they're asking for. And it's really taking, okay, we are professional investors. We have a team. I literally have a mortgage team of 4 or 5 people working on my mortgages on a day in, day out basis. So I understand I'm equipped for this. The average person is not equipped to go get money. They're just going to shut it down. They're just going to say, forget it. I'm just going to rent for another year or 2 or 3. This is hurting our Canadian economy.
Yeah, but we have to qualify a couple things here, JG. Number one, it's investment. So the banks are already got a flag on you because you're an investor. So anybody that's got an investor in front of them, investor handle, they're going to be very, very cautious. But overall, I think the real underlying message, which isn't being stated, is that, of course, you got the politicians, talking about we're going to make it more affordable and blah, 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 all the rhetoric that they put out there, which is just rhetoric. So the point of it, my point is this, is that when we look at the opportunities that are out there in terms of buying opportunities, there's lots of great opportunities for first time homeowners or home buyers to get in the market. But when you go for financing, what the banks are operating on top of, I believe, and they're not talking about it, is the risk, their portfolio risk. The bank's portfolio risk is increasing quite dramatically. And we'll talk a little bit about it later on in the show. But ultimately, when we consider that our debt to GDP ratio is at record highs. So this goes back to what we've talked about many times. Canada's economy is driven so much by consumerism and so much by real estate. And guess what's happening? Both are slowing down dramatically. And so the bank's risk profile, they've got to make sure they're tightening up. They can't be just as loosey-goosey, as they say, as with their mortgages as they were in the past.
I think you're bang on, Patrick, and I think the bank, like, we're going to talk about Iran in this show for sure, and what recently went down between the U.S. and Iran. We're going to talk about that, but like that kind of global conflict is a big deal to a bank. Like they look at that and they have swaths and teams of people to analyze the risk that adds to their portfolio. And when you combine Russia for the last 2 years, tariffs in the last 6 to 8 months, and now this conflict. I mean, there's just no stability for them to get back to. It's just risk on top of risk on top of risk. And they get in these negative risk kind of cycles. And I see all the lending institutions there right now. And you remember, Patrick, it wasn't like, I don't know, maybe before the tariffs, I was saying that we were just like they were starting to get creative again. I saw new programs coming out. I was talking to my mortgage teams, and they were talking about new programs coming out and making it easier to finance and so on and so forth. All of that's off the table right now. I mean, they've paused. I haven't seen any of that creativity anymore since the tariff talk started, because that just added a ton of uncertainty to them. And these guys they can't operate with uncertainty. They're bankers. They wear suspenders and a belt. I mean, listen, that's who these people are. It's crazy.
Well, okay, but let's there's something that we keep talking about, this tariffs. I'm so tired of it. Blaming tariffs. And I'm not saying tariffs don't have an impact. I mean, I'm very aware of some of the challenges that many corporations are facing because of tariffs. So I get all that. But that isn't what, I mean, that's just part of the problem. There's been 10 years leading up to this. I mean, gosh, even let's say even if we just go from 2020, let's just talk about the past 5 years. I mean, when we look at what we've been through, what we've gone through, the banks are looking at, yes, there is we got the tariff wars going on. We can blame part of it on that. Then we've got the real wars. You got Iran, Israel. Now the U.S. is in on it. Who knows, China, if they get on it with Russia. I mean, this whole thing could come off the rails in a very big way, but that's relatively new. The banks started tightening up before, so they may have known something. But more importantly is what we'll get to within this headlines is the fact that the unemployment rate in Canada is going up, and a big part of it is because of what's happening or not happening in the real estate world. And Toronto and Vancouver drive those issues in a big way on the construction side of things. Many are losing their jobs. The bank is not blind to seeing what's going on in the economy. We're looking at data. Think about their front lines people that are actually dealing with clients who have been laid off, lose their job, household income has been interrupted. They're seeing it firsthand. And I believe that the banks are being, I guess, proactive in risk mitigation by just tightening things up, because they see the GDP to debt, that's a big issue. They're seeing the unemployment numbers go up. They're seeing it in real time. So I think they're having trouble being optimistic about what we're doing going forward.
Patrick, this is the headline you're talking about. It's this one here that's on the screen that talks about how, GTA home building is now, they're projecting the people in the GTA are going to lose 41,000 jobs. $10 billion is going to evaporate because of the home building slowdown. And, we've been talking about that for, gosh, 2 years now. We knew this was going to happen. Now it's come a little later than probably you had thought, Patrick, but still it's happening. But this is the negative part of the cycle. We are clearly the data showed that we were entering again different provinces. Let me just speak to in general Ontario right now. which is we were entering this the backside of the boom cycle, which is this, there's the boom, there's the recovery, and there's the bust part, and this is where we are. We're in the bad part of the cycle right now, and it self reinforces until it gets to the bottom, Patrick. And this is the kind of stuff we're talking about. I mean, there's just no good news. As you can see, it's impossible to find any good news out there, and that tells me that we're heading towards the bottom. I'm not calling the bottom right now because there's so many damn things that are going on. There's no way I could do that responsibly, but I can see that by the sentiment in the market, it's just bad on top of bad on top of bad. And these banks and these various lending institutions, they have to operate within that. And they're not risk takers. I'll tell you that right now. They're not risk takers. So as a result, they don't help the situation either.
100%. And I mean, but you made something, an interesting point, which it becomes a self-fulfilling prophecy in all of this and this whole thing, this whole slowdown. So we look at, the tariffs were a real tipping point, I think, for Ontario. Ontario was already starting to slow down. And as much as the housing kind of carried it through, underneath and behind all that, the Ontario economy is already slowing down pre-tariffs. All the tariffs did was, take it to the next level, which was hit the tipping point. And so now we see Toronto, and we keep coming back to this, is that condo market was such a huge part of what was going on in Toronto and outside of Toronto, GTA, and in Vancouver. And then all of a sudden it's done. Like there's nothing going on. And we've got some charts just to show how dramatic it is. I mean, condo sales are the worst they've been in 30 years or some ridiculous number like that. But that's not the only part of the market. So it's all to say that, when we look at going through this slump cycle, and we have to really segregate, the fact that the condo market is the condo market. And the single family detached is also getting a little bit soft in certain areas, but not across the board and not to the degree the condo market is. But what's happening is so many listings are out there and there just isn't enough buyers to accommodate those listings. So we're starting to see listings go up. We got months of inventory. I want to say that I looked at the chart the other night, and I want to say that when I went at the Rein meeting, I want to say there's 5 years of condo inventory in the hopper right now.
This is what you're looking at right here. This is the pre-construction condo supply it's just approaching 60 months, which is 5 years, which is incredible.
It'll break that ceiling. It will definitely go beyond that.
Yeah, and Patrick, I like what you said about the condo sales. I mean, these charts are quite staggering. You hear these headlines, but you look at the data, you think, "Holy crap!" It's just incredible where this is going. And the unemployment rate, in Toronto proper, is definitely creeping up. It's just below 10% now. I think it's over 9. It's heading towards 10%. And this is the kind of stuff you're talking about, Patrick. So it is a negative reinforcing cycle. It just goes from bad to worse. Something has to give. My question to you is, what do you think is going to take it out of this? And I'm not saying that I'm not asking you to predict this month. It's not going to happen this month. But what is going to be that precipice that's going to break this cycle, Patrick, and have it start turning around? I mean, I think the lending institutions and them easing up the ability to get credit. Because what we have eased up is the rates. So the rates have eased up. I did a line of credit deal the other day, and I think I got money on my line of credit for, gosh, just over 6, like 6.1 or 6.2%. I mean, that's cheap money. Nothing wrong with that. You can do a lot of great real estate to use your line of credit money at 6%. It's not 9, it's not 10, it's not 11. I mean, 6.1%. And this is just a normal unsecured line of credit. Like, it's nothing fancy. It's just a BMO line of credit. So my point is that the rates have come down, but the ability to get this credit now, and like, just for the average person who's trying to make stuff happen in their life, man, they have just clamped it down so hard. It's crazy.
Well, and it boils down to property type. It boils down to, what province you're in, what city you're in. So we look at what's happening in Ontario versus what's happening in British Columbia. And then, of course, we look at Alberta and we look at Saskatchewan, two economies that continue to do relatively well, and they continue to be quite strong. Although there's some concerns, I'm seeing some concerns, not concerns. That's not true. I don't want to call it that. We see where Calgary's now entered into that slump cycle, which isn't to say it's crashing and burning like 2015. I want to just qualify that. A lot of people are calling for an absolute meltdown in Calgary. And I'm going, no, there's not going to be a meltdown in Calgary. It's going to be soft, yes, for sure. And it's going to be soft in the condo market, which, that's no surprise. We've been talking about that for 5 years. The point of it, where we go, let's go back to what you're talking about, where you said, what do we think we're going to get at? When are we going to get out of this? I don't have a timeline. My timelines suck. I'm right, but I'm often right way later than I anticipate, because you just don't know what freaking politicians and bureaucrats, how far down the road they can kick the can.
That's the influencer part of the cycle, right, Patrick? I mean, the data tells us where it's going, but how fast it's going to get there and how fast it's going to move through that cycle, we don't know because of the influencers in the market. The influencers are interest rates, the influencers are politicians, the politics of it all, the policies of it all, the bullshit of it all.
The bullshit of it all, the outright fucking lies of it all. It infuriates me. Excuse my French. But anyways, the point of it is when we look at what's going on. So I think for Toronto condo market, it is going to be multiple years before we see any form of recovery. That's what I'm looking at. And something we don't want to step over is the shutdown of immigration. I mean, ultimately, the first 2 quarters of 2025, they've hit the brakes hard on immigration. So we're not seeing as many people come in. I don't think I have an immigration chart in front of us, but the point is that immigration is down dramatically. So we're going to continue to see, and especially in the non-permanent resident cohort, as well as students, we'll see more. We will see an offset of refugees coming into the country for sure. That'll start to happen more than just Ukraine. And then on the other side of that is that that's that one part of it. So we're going to see rents in some areas softening. We'll probably see demand for rental units soften a little bit, but there's also the cohort called first-time home buyers that can't afford a home. They're renting. So it's a really messy market. And when we look into the future, and I want to qualify one thing here. There's so many great investment opportunities in this market, but people don't want to jump through the hoops to get financing. They don't want to go write offers. They don't want to go hunting for deals. But it is in these markets that there are some amazing opportunities, JG. I mean, you are working it with Vista Property Group, your business, but ultimately this is a great opportunity, but it's really scary because nobody knows what's.
I agree 100% with you, Patrick, and I want to come back to this slowing population because it is having some ripple effects, and these ripple effects come and go. Like if you think of a wave, a ripple effect, sometimes you're at the height of that ripple effect and you really feel it, and then other times you don't feel it as much. But one place that is definitely feeling the ripple effect is in student rentals. I'm seeing a ton of people having very difficult times with their student rentals. And that's because student rentals are way down because they're not bringing in nearly the amount of immigration through the student programs that they did 2-3 years ago. So everyone who rushed out built a student portfolio. Some of them are very much struggling now, Patrick. But the other ripple effect is that rents. I'm seeing rents, especially in the last gosh, 4 to 6 weeks. Rents have really come down. I was telling you 2 months ago that rents were like a little soft. You were off $10, $20, $30, maybe $50 from your rents, but it was nothing to worry about. But in the last 6 weeks, that has accelerated. And some of my rentals, I'm down $150 an apartment in some particular cases. So it really depends on each apartment. And this is where, Patrick, and you've said this beautifully for years. You talk about those properties that you create rentals out of that are not the greatest rentals. That property that's by the gas station in front of the dumpster that you talk about. Like it's in these moments that those properties just suck. And those properties now struggle like crazy. So if you're sitting on a property that is just not renting, man, you have to upgrade right now. Like we are so busy at Vista Property Group right now. We got like 30 plus active projects on the go right now because people have to upgrade their rentals. Otherwise, they just don't rent. I mean, it's that simple. And even some of the more upgraded ones are having a hard time renting because we got to pull those rents down a little bit. And of course, after you just put a ton of dough into your property, you don't want to pull down your rents, but you're better off to pull down your rents today, get it rented, get it stabilized. You'll recoup that rent later down the road because then you'll start getting the premium. But not every investor understands that. It's not easy to understand. It's a tough market right now, Patrick.
It is a tough market. And, at the recent RAIN meeting, there's a couple things that we need to hit on. First off, when we look into the future still looks bright, and we just have to look at it through a different lens. But I want to just kind of shine a light on a couple things. First off, I am shocked at how little Albertans know what's happening in Ontario. Like I talk to people across the country, and when I talk to guys in Alberta about what's happening in Ontario, they kind of know, but they're not really, because they're not attached to it. They're not really engaged in it. They don't really understand what's happening. But there's a lot to learn from what happened in Ontario, which is we get caught in the boom cycle. You're a freaking genius. So go back to what we were just talking about, JG. Everybody's a genius. And I keep saying to Alberta RAIN community, guys, this is not people. This is not the time to over leverage. If you've got $100 cash flow and you're thinking about pulling the trigger on that deal, you got to ask yourself, what if rents come down 5, 6, 7%? Are you going to be okay with that? And, this is the time to be very conservative. In this boom cycle, in a boom cycle, everybody's so excited about buying real estate, they're not paying attention, and they're literally willing to buy that home across the alley from the service station with the dumpster that gets emptied every day at 5 a.m. Like, because they're just chasing deals and the price is right, and oh my gosh, at least it'll rent. And but when it doesn't rent, it doesn't rent, and it will never rent.
Let me go one step further than that, Patrick, because I like what you're saying there. And I've been thinking about the exact same approach, but the opposite way. I'm thinking back to the days in 2018, 2019, early 2020, before COVID, when you and I would travel to Alberta and we couldn't convince anyone to buy anything. And we were saying, guys, this is not going to last forever. You're just happen to be in the slump cycle right now. The recovery will come and the boom will come. And we said that for how many trips to Alberta, Patrick, that we were set, and nobody was listening. And now all those people are trying to crowd in, and I'm not saying it's too late, but I'm saying you missed the big. You didn't miss it, but anyways, you missed a big move. I'm not saying you missed the big move. I'm saying you missed a big move. You missed a huge run up into the market. So. And it's the same now. So my point is, Patrick, is that for those people that want to be in Ontario, that think Ontario has a bright future, and a community within Ontario, because you can't just look at Ontario, you have to look at like the particular region, right? I mean, now is the time. You're in the 2018 or you're in the 2015 of Alberta, and you got to think about that, Patrick.
100%. And I'm gonna do this. I'm gonna say, Jamie, our producer, you need to bookmark this, because what I'm about to say, and I may change my mind later, but I don't think I will. 2025, you're going to see interest rates come down. Variables are going to come down a little bit, but you're going to see quantitative easing. And as soon as you see more money coming into the economy, you're going to start to see asset prices go up again. I think we'll see that by the end of 2025. That's what I think is going to happen, given what's happening in Iran and Israel, blah, 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 the war thing that's going on. And interestingly enough, people are, we saw oil prices as of today came down a little bit, which is a little bit surprised, but it's really what has happened is people have normalized this whole fighting thing, this whole war thing. They don't realize that they think the war's over. Like, people are going, oh, okay, well, U.S. went in, bombed the shit out of Iran. This is over. We're done. Iran's going to fold like a cheap tent because they don't want to compete with Israel and the U.S. and NATO and blah, blah, blah. And that's just not true. I think it's going to get far worse before it gets better. That's my own read on it. But how economically that affects Canada and what will be, and given the fact that now, what did they give? $100 billion that we're going to, Carney's decided to add 95 billion, call it 100 billion, to the fund to push back on Trump's tariffs, and Canada is going to impose tariffs on the US. I don't know. That's a pretty bold move to fight with your neighbors that way, but that's the decision that apparently has been made. All to say this, we're going to see economically things will get a little bit softer, and I think you're going to see QE, and I think the Bank of Canada is going to have no choice but to bring the overnight rate down a little bit.
So QE, quantitative easing, means that the government is pumping money through a variety of means, by the way, into they could be buying bonds or could there's
I
a
think
bunch of ways that they do it.
we could end up with UBI. I really believe that by, well, probably into 26, universal basic income is going to be going out to some cohorts. And I really see that starting to shape up. That's what I think is going to happen. Now, that's not to paint a doom and gloom picture. It's to paint the picture that whatever the economy is, we have to adjust and kind of lean into whatever's happening in the economy. And we know that hard assets rise when you start when you implement QE and lower rates, which I think is ultimately going to happen on the variable side, on the overnight side. I think we're going to start to see another lift in 2026 on real estate in some parts.
Let's dig into the Iran conflict real quick. I mean, what's your, I think, of course, I'm sure we all have our own opinions on the various things, but I want to talk, just for me, I want to talk about real estate. I mean, how do you see this impacting real estate? What are you doing about it from a real estate perspective? How are you thinking about it from a real estate perspective? What are its impacts on real estate from that perspective?
Well, it's hard to just look at just real estate. We have to look at the overarching economy, and I think overarching, we're going to start to see things slow down. I'm stressing again in Alberta, less in Saskatchewan, but for sure in Alberta. BC and Ontario are already going through it. It's going to continue to be softer. For real estate investors, this is where opportunities live. This is literally where you can negotiate deals. You can find properties that will in fact rent because there's demand for that style of property. Know who your demographic is. Be conservative. Do not over leverage, and go back to that 25% down. And or have cash available that you're padding, because liquidity is always the issue. So you consider that. I think probably for the next 18 months is normal cycle. We're going to see things be pretty choppy and pretty soft, but this is where you don't have to rush to buy deals. You don't have to chase deals. You can just go in, solve other people's problems in their real estate, and be able to capitalize on those opportunities by solving those problems. So you got to be a little bit more savvy. You got to be more focused, and and don't find yourself chasing deals. There's always another deal. I actually had a Rein member who's really, she's all upset. She had set a goal. I'm going to own a 12-unit building in Edmonton by X date, and I don't own it. And oh my gosh. And she's really beating herself up. And, my guidance to her is don't rush. Don't force the river. Go with the flow. So don't beat yourself up because you didn't hit that goal, didn't get that deal done. There's always another deal. So that's my read on it. I liquidated a couple of properties in Edmonton. That is to actually get into a better cash position, because I believe there's going to be some great opportunities over the coming months. So that's where I'm looking, and those properties were for me were done anyways. It was time to exit those properties.
That is what I'm seeing as well, Patrick. I have a lot of clients right now at Visture. They are, I got an email last 2 weeks ago. I got an email from a client saying, "Listen, JG, I'm going to liquidate a property in order to shore up my cash position. I need to invest in my other properties. I need to get them up to snuff." I just got an email 2 days ago from another investor saying, "I'm going to sell two properties in order to shore up my portfolio." So and that is a good strategic move, Patrick. There's nothing wrong with that move. And a lot of investors, like when they sell a property, they feel like they're selling their babies, right? So they kind of like they really want to hang on. Guys, these are just assets. These are just doors. And there's so much attachment to, like, I have 12 doors and I have 8 doors, and now I'm selling 2 doors, and now I'm down to 6 doors, and you don't feel as successful and all that bullshit. But it's just that. These are all self-imposed stories that you're putting on yourself, and for many people the right move right now, and of course this is not financial advice, you got to look at your own situation, but don't be afraid to liquidate a property that maybe has quite a bit of lift in it, that you did very well on it, then you want to take some money, some profits off the table in order to reinvest in the rest of your portfolio. Because if there's one thing I have seen, Patrick, and this is where those investors are paying the price, and that is the investors that have been cheap, the investors that have cut corners, the investors that did not invest in their properties and maintain their properties all the way along. Those investors are hurting today because everything, mortgages are a little bit more expensive, cash flow is a little bit down, rents are coming down, and these guys are having to pile money into their portfolios in order to keep it going. And this is a very important lesson. As we get out of this cycle and into the good side of the cycle, because it will happen. Is it going to happen in 2025 or 2026 or 2027? I don't know, but it's going to happen. You will rebound into the recovery and then the boom side of the cycle. Don't forget to maintain your properties. Don't forget to invest in your properties and capitalize on the good times so that you can get through the bad times, Patrick.
Well, and let's not step over a couple things. First off, we've said this many times and I'll say it again. We're in the emotion of what's happening today. All the bad news headlines and condo meltdown in Vancouver and Toronto and the wars and all the rest of it. We have to just clear the clutter, okay? And say, as investors, we have to say, what do we think it's going to look like in 2 years from now? So we're actually looking at the trajectory of what's happening today and saying, where is that going to leave us in a couple of years from now? So something that we need to consider, and this is, I think, where opportunity exists, and that is arguably whatever data that, StatsCan has, they're saying that 30% of our condo market for sure, but overarching housing market was driven by investors. Well, those investors are gone. There is no 30% of investors buying real estate. Okay, that's the first part of it, right? So when we say, okay, well, what does that mean? It means that the real estate market is going to continue to get softer, and there's going to in certain segments, and I'll qualify it in the condo market as well, and say that what's going to open up the door of opportunity for those who bought right, paid attention to the details, who are still doing okay right now. It's going to open up doors of opportunity to increase their portfolio over the coming months because things are going to get a lot scarier and a lot softer. So that's kind of how I'm looking at it. But it all goes back to don't stop, keep looking for deals, get liquid, clean up whatever mess you made during the boom cycle, whatever you can clean up, and then get solid again, and then start looking for deals. This goes back to, and there's always a correction, isn't there? There's, in any economy, we think it's going to go like this forever. We talked about this. We think it's going to go up forever, or we think it's going to go down forever. We're both wrong. Now it goes up, it goes down. The key in all of this, JG, is that there is we'll call it a flushing out of those who got in, chased the market. We saw that again. We'll keep hammering on the condo market. All of those speculators, all of those gamblers, all of those uneducated individuals who are just chasing money got themselves in trouble. That's got to flush through the system, and it's going to be painful. And, I do feel a little bit sorry. There's a part of me that, let's talk about this. Think about it. There are developers that are laying off people. There are developers that have gone bankrupt. It's a mess. It is really, really ugly. But, there's a part of it I'm going, something, you were making decisions and you were driven by greed. You were pitching deals that were bullshit, and now it's all catching up. That's how I'm looking at it. So I'm a little bit cold-hearted around some of these developers who, oversold, they overpromised, they underdelivered. And, there was lots of mortgage fraud going on through that time that they knew about, but they let it go. So this is like cleaning up a mess.
I agree with you, Patrick. I agree. But this is what the market does so well. This is the market mechanisms. Like the market is like Mother Nature. It cleans up its own shit if you let it go long enough. And this is exactly, I definitely do not want, government intervention or some other stupid policy or some way to limit this. I mean, this is what the market does. People get going and they go too far, they go for too long, and and like you said, then there's a flushing out of the system, and we start again. The thing is that it's actually quite predictable, and
It is.
if you know
Okay,
what
but
you're
hold
looking
on.
for, which is hopefully why you watch this show, because we're telling you what to look for, so that you can be on the right side of the equation, if you know what I mean.
So let's go back. Let's go to that headline about CMHC. So imagine CMHC at some point had a goal that they were said, what? We're going to get to, we want to get back we want to get housing affordability back to 2004 levels. So think about that, JG.
It's just
CMHC,
ridiculous,
what is the headline?
ridiculous.
They discovered they'd be insolvent if affordability returned to 2004. Oh, really? Like you just figured that out? This is the rhetoric that drives me crazy because so many people buy into it and they're going, oh, well, the government's going to try and save us and they're going to bring the housing affordability down. Think about this. What do you think the chances are of affordability or housing prices coming off dramatically any more than they have? Think about the mess they're cleaning up in Toronto, Vancouver right now. And in behind that, all of those developers that are declaring bankruptcy, they're suing, like the banks are having to sue. There's no money. It's a mess. So hence they tighten up in terms of their lending.
Well, Patrick, it goes even one step further. We talked about this. The banks are actually overlooking the valuations in some of this real estate just to make the deals work because the real estate is the collateral layer to the whole system. So if you you can't let it fail. The whole thing fails.
And the whole thing fails. And the debt to GDP ratio, both from the personal, like as in the general public, as well as our government, is off the chart. So every dollar that is being spent on, funding Ukraine, and now what does Carney want to do? I think he's helping the UK or the EU get back into speed. Like I don't know where do we think this money's coming from? They're borrowing it. All they're doing is borrowing more money. So it's more deficit. So every dollar is debt. So we have to get to that point. So the reason I'm saying that is that we have to think this through. Will the banks and will our federal government, even our provincial governments, do they really want to see real estate prices coming down? Really? 100% they do not. And that would absolutely crush not just our economy, it will absolutely crush the banking system. So like we talk, it's just not going to happen there. And this is why we go back to QE. They will start figuring out how to get more money in the system. And they'll have all sorts of reasons for it. And as Gerald Salante says, when all else fails, go to war. That's what happens.
Oh, interesting. That just happened this week, Patrick. Interesting.
Well,
Now,
they need a reason. They need a reason. They need a
exactly.
reason. And so what's Carney doing? Oh, gosh, we got to fund Ukraine. We got to go to the EU. Gosh, we got to pal around with them. Canada's like just another, the ugly sister of Europe. I don't know what the hell that language is. It's just pissing me off because it's just rhetoric.
Now, Patrick, as we're shooting this, and I want to get to some other provincial and economic data, I want to get into the goods. But as we're shooting this, there was just Trump just announced an official ceasefire that is supposed to take effect in 6 hours from now. So that'll be essentially Tuesday at midnight, roughly. When this official ceasefire is supposed to take place. So it looks like the war that just started a couple of days ago, it looks like it's over, Patrick. You actually called it. This is the first prediction that you were so accurate on. I mean, literally, there's like 20 minutes to reality right there.
There you go. Well, I follow it. I'm surprised at how few people are actually following the minutia of it, and it takes some time to do that. But yeah, and do I think there's going to be a ceasefire that's going to last? No, I don't. I don't think Iran's quitting. There's no chance. Well, maybe we'll see. I doubt it very, very much. What the hell do I know? Never say never. I think the bigger risk should Putin and China all of a sudden decide that they need to do something, that's when things really will escalate and get out of control. But we're literally on the verge of a full-on World War III, and anybody who's not paying attention should be paying attention to what that could lead to. So all to say this, pay attention to the details there. It's not a bad thing for real estate, by the way. Again, as soon as you get QE, you get inflation. Inflation covers all aspects of it. If the Strait of Hormuz continues to be shut down for an extended period of time. We can't get through goods through there. We can't get oil through there. There is no question that we're going to see crazy inflation, and inflation certainly in the oil and gas and fuel. When you go to fuel up your car, and food, that will be part of it. But it all goes. Everything rises. I mean, that's what's going to happen.
Yeah, yeah. So let's dig into some official rental numbers here, Patrick. So as you can see here from this chart, essentially BC is down 2.9%, Alberta is down 5.8%, Ontario is down 3.4%, Quebec is down 2%, Atlantic Canada is up 3%, Manitoba is up 0.1%, and Saskatchewan is up 2%. So that's where the rents are at. But again, it's very dependent on kind of region, Patrick, because like what I'm seeing in my market, in some of my markets, I'm seeing rents down up to 5%, even up to 7% in some cases. But I do want to stress something. It has a lot, that number has a lot to do with who you rented to last time and how much you got last time. Because let's just say you have a two-bedroom apartment that is a two-bedroom apartment here in Ontario is somewhere between 2,000 and 2,200, let's just say. Okay. So 2,000 to 2,200 is the going rate for pretty much all two bedrooms that I rent that are in really great shape, that are premium, so on and so forth. Now, let's just say last time I rented it for 2,300, which would be $100 premium over the top of the market. And this time I rented for, say, 2,000 or 1,950. Well, in the mind, it's like, well, rents are down 12%, but that's only because last time I got such a premium for it. It looks like I'm way down, but that's why I say, Patrick, that's why it's important for people to realize that, the market will this is what the market does. It flushes itself out, and rents, they get aggressive and then they come back down. But definitely, I'm agreeing with this data, Patrick, and I don't always agree with this data. But yes, I would say rents are definitely trending down for me from their all-time highs for sure. And I've really seen it in the last 6 weeks. I started seeing it maybe 8 to 10 weeks ago, just little hints of it. But the last 6 weeks, 4 weeks, 2 weeks, it has been getting worse and worse and worse. And I'm curious to see where it's going to stop. And that may be, right now is a good rental period. The summertime is a good time to be renting. So more on this as we go forward. We're going to want to keep a close eye on this throughout the summer. No doubt about that, Patrick.
Well, and just to shine a light on it, I think Calgary year over year was down 10%. So that 5.4% that you see happening in Alberta, a lot of that average is driven by Calgary. So that's just a kind of a note to the side. But
yeah, look at there. You can see on the left-hand side, Patrick, Calgary's down 9.9%. Edmonton's only down 1.3%. So you're absolutely right.
But to your point, those are off of all-time highs. And this is, if we could get this message and people could just get it, is that in these big boom cycles, you have to look at it and go, I get that I'm getting these premium rents right now, but this too shall pass. These peaks, there's peaks and there's valleys, and things are going to soften for the next little while. And so what we're seeing is things coming off of the peak rental market, like where rents were really high. So it's all to say that things are going to get softer for sure. You can count on that. So just manage yourself accordingly. That's really ultimately it.
Now, interesting though, Patrick, typically, very oftentimes, the buying and selling market kind of is a teeter-totter to the rental market, meaning if the buying and selling market is down, the rental market's going to be way up because those people that should be buying and selling, they're actually renting, and that pushes up the rents, and vice versa. If all those people that are renting get out of the rental game and they go to purchase, well, the purchase price is going to start to go up, but the rents are going to come down, right? Now we have not seen much action on the purchase side of the equation, not in my market anyways, but we are seeing the rents come down. I'm curious to see if this is a precursor to the next month or two where you're going to see some more buying activity. Although I know that one of our headlines is that right now they're categorizing the market as a negotiation market. I think they call it, not a buyer's market, not a seller's market, but a negotiation market. I think it's a whole new term.
Well, I'm not familiar with a negotiation market other than to say it's a nice way of saying the market's quite soft and here's an opportunity to get out and do some deals and make some offers. And so that's really ultimately it. I think there's a couple things that we can't ignore. First off, the economy is softening. Secondly, we are seeing unemployment go up right across the board. And thirdly, we're looking at the fact that even interprovincial, more people are going to Alberta. Alberta is going to be a bit of a concern in that people are going there because of affordability, but they're running out of jobs. So I don't know how that market's going to balance out. I think you'll see a good upside to Saskatchewan because people will go there because there is employment there. But when you look at GDP right across the board, although Alberta is kind of higher, in terms of GDP forecast and what's going on economically, none of these GDP numbers are anything to like brag
No,
about. You know,
I
they,
mean,
they,
this is the official TD forecast right here on the screen. And yeah, I mean, Alberta's at 1.8%, and it's the star. Actually, Newfoundland's at 2.1%, but does that even count? I don't know. Probably not.
well, it doesn't. There's this lack of population, right? But
Yeah.
1.8 or 1.9% GDP is good. I mean, it's better than the negative side of that. But I think those numbers are going to get adjusted in its lag, by the way, and you're going to just see a really flat economy going forward. Ontario is going to continue to get hammered, I believe, especially because of what the tariffs are doing. That is the tipping point for Ontario getting soft.
The recent reports from Ontario, the GDP in the first quarter was better than anticipated, but that's just because the tariffs pulled all those sales forward, and people that were going to place a lot of automotive business that was supposed to get done all year ended up getting done in the first quarter. So the numbers in the first quarter look better than anticipated, but it's a bit of a false. I'm curious to see where Q2, Q3 go, because you might be right, Patrick. It might be a little bit painful here.
Okay, so JG, you're okay. I'm going to take this totally off the rails. I'm going to throw a whole curveball at you because you love it. You love AI. You love self-driving cars. You love technology. What's going to happen to our employment scenario when over the next literally couple of years we're going to see more and more robotics taking jobs? What's your kind of read on all that? I know that we never talked about this, so this is real time. What's your thoughts, buddy?
You know what? I'll tell you what. This is so right. It's the first. So they're calling it. I think they're calling it the Great Decoupling, which is in the last forever times since our world has been around. Our GDP has been linked to employment. The more that people are employed, the more people earn, the more our GDP goes up. Pretty simple, right?
But let's be clear. That's productivity. What I hope everybody has learned, that government bureaucracy is not productivity. And that has been problematic for Canada for many years. So I want to just qualify that
Yeah,
because
I'm
GDP
on
is
board.
about
I'm with you.
productivity. Okay,
I'm with
got
you.
it.
I'm with you. But now what's happening is now you're going to have the great decoupling, which means that productivity is going to decouple from people. So you don't need people anymore. You're going to now need robots and a variety of other ways to create productivity without the people. So this is going to create some serious wrinkles in the soup, if you will. I mean, the whole system has to be rewritten, Patrick. The very way that we measure GDP is going to have to change. And like there's a whole, so, in the next 2 years, 2 to 5 years, it is going to be so messy. It's going to be so chaotic. It's going to be unbelievable. And people are going to lose their noodle. There's no doubt about it. But on the other side of it, once we rewrite the rules to the rule book, then we're going to see it. And I don't know what those new rules are going to be, Patrick. What I do know is this is a foundational change of the productivity decoupling from the people. And that's never happened before. So there's no place to go to have a look at this stuff. But just because people won't work as much, it doesn't mean our GDP is going to go down. And I'll give you a perfect example. My grandfather, and Patrick, you've got 25 years on me, so you can speak to this even better than I can. But my grandfather worked 7 days a week, 364 days a year. Okay, the only day they got off was Christmas, and they worked the rest of the time. That's what they worked, and they earned obviously a whole lot less than we did, and they worked a whole lot harder than we did, and so on and so forth. And the GDP was a whole lot less than it is now. And I realize you're going to tell me that a lot of that's been funded by debt, and you're not wrong about that. But the point is we went from them working 7 days a week, 364 days a year, to now us inventing this concept called a 5 day work week, 8 hours a day, 5 day work week. And there's a lot of talk on how that's going to change to probably going down to a 6 day work week and only 3 or 4 days a week. So the people are going to work less and less and less, but it doesn't mean they're going to earn less, because there's going to be there's this decoupling of labor and productivity. So I don't have all the answers, dude, but that's the beginning of something interesting to dig into.
Well, it is interesting. You and I both embrace, AI, and we love using the AI that we use it for. But so think about let's just throw a couple of curveballs in there in just terms of thought process. So yes, there is the robotics of things that are taking jobs. We've seen that. And I mean, you look at giant, million square foot warehouses and 6 people work in it. The rest is robotics. The point of it is around, just think about where we use it is really eliminating a lot of bureaucracy. So can you imagine if you're in the government and you have to implement AI into whatever government bureaucracy, knowing that this too shall take your job? Because that's really one of the gifts of AI is that side of the equation, right? Is in fact the bureaucracy of it, the administrative tasks amongst other. But I want to throw one other curveball in there, JG. When I was a kid going to school, and the first thing that came in was calculators, Texas Instruments, right? And it was like $200 for a Texas Instrument that you would take to chem or to math or whatever. And everybody's going, oh, kids just don't know how to do math anymore, and they're using these calculators. Well, $200 calculator is now worth $5, or they give them for free at whatever event you go to. My point is think about the educative part of so we've got traditional schools and education, and how much education do kids need relative, or what kind of education do they need? That might be a better question to ask, relative to what's going on with AI, when I don't need to know anything. I'll just ask my AI pal.
We could do a whole episode on this, and I like
I wanted to go off.
the
I didn't want to go off on a rail, but I
no.
wanted to see what your thoughts on it, because it means jobs, right?
Well, there's a couple there. I want to touch on a few things. First of all, I have a ton of my staff. They all have kids in that like 5 year old, 8 year old, 10 year old, 12 year old, 14 year old range, and I'm just like, my gosh. I mean, I would. It's a tough place to be a parent nowadays. If you see what's coming down the pipe, it's like, how do you help your kids? I don't know. That's a whole other episode. I'm not. I can't go there today. But what I will say is this, Patrick. I do not believe. I do not believe that all this AI and all this robotics is necessarily going to take the jobs. It's going to take some jobs, and some people will need retraining. There's no doubt about that. And there's plenty of evidence of this over the generations that have passed. How we used to 80% of us used to work in farm fields, and now only 3% work in farm fields, and all those various examples. I mean, you can easily go figure those out. But so I don't believe that we're going to lose jobs because of this. Because if you look, Patrick, right now is a perfect example. Like I've implemented AI to the fullest extent that I can. So have you. Are we? Am I working less? Are you working less? Hell no, I'm working more. But I've tripled my productivity. I've hired as many, and if you go back to this example that you gave of this big warehouse with all the robotics, we don't have the people to take those jobs. Like there's not enough people to take all those jobs, even if we wanted to give them jobs. So we need the robots. I've been saying this for how long, Patrick? We need the robots. Like I could hire more. If I had robots today, I would put them immediately work. Why? Because I can't find the people in order to put them to work, but I have the work there. So I just need the robots. So I can put them to work.
I 100% agree, JG. The thing is, we don't know. I bring it up only in that when we look at unemployment, we look at jobs, we look at debt to GDP ratios, we look at the rising cost of living in some areas, and then the decreasing cost of operating in other areas. And so it's something that we all, I think, need to pay attention to, is all I'm suggesting. And that as we go forward, as investors, as business people, we have to stay in tune with what's really going on. And these are questions that we have to spend a little bit of time investigating, creating that thesis, looking into the future, again, 2, 3, 5 years into the future. I still
Listen, you might find. Let me give you another thought process, Patrick. Sorry to interrupt, but you may see a world really soon, as in the next 12 months, 24 months, 36 months, where you're going to have increasing unemployment and increasing GDP at the same time, and that typically could never happen. But you might see that this time around. because of the decoupling. Just as an example to show people. So, unemployment is a measure that it might become very useless very quickly. In fact, unemployment is already a useless number. Employment is more important than unemployment, but I digress.
Yeah, yeah. And I think, who knows where it's all going to go. I throw the question out there, food for thought, think about it, see what we come up with, but we know that it's going to have an impact.
I want to hear what people think. Put it in the chat, folks, what you think. I'm curious on people's thoughts around this. And I do think we need to talk about more often, Patrick, because these are the exact kind of conversations that are going to get people comfortable. Because listen, this is happening. Like, it's not a question of whether or not this is going to happen. We are going to be hit by this AI revolution. And those of us that are ready are going to benefit, and those of us that are not ready are going to struggle. And Patrick, we've that's what we do best is talk about waves before they happen.
Exactly. Look into the future. That's our job.
All right, Patrick. Well, that was a really, really great episode. So many great topics of conversation, and I love the differing opinions. And I got to tell you, we got to dig more into this AI conversation because this great decoupling is going to have a major impact on the future.
And I just want to wrap up one final statement, which is, for those who are looking on YouTube and the talking heads, I spend a lot of time looking and listening to other YouTubers. It's all doom and gloom and housing and, shilling and all I'm saying is this: there's still great opportunities. You must build an asset base, hard assets. Real estate is part of that. You've got time to write offers, negotiate deals, and build that portfolio of hard assets, real estate being one of them. Stores of value, so important as we go into this new age and new wars and all the stuff that's happening, JG. That's my view.
Look at you, Patrick. Who's got the rose-colored glasses on now? Looks like it's you, buddy.
Well, I'm just telling you, it's rose-colored glasses because we're in this slump cycle. This is where opportunities exist.
Thanks for a great show, Patrick. And folks, thanks for watching.
If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.